Welcome back to The Explainer. Today we're diving into episode 10 of our series, and we are finally tackling the absolute most asked question in property investment. We're talking about timing the market. When exactly should you buy, and when should you sell Singapore property? It's a high-stakes game, honestly, and getting this right can literally mean a difference of hundreds of thousands of dollars. It's the ultimate dream, right? I mean, everyone wants to know the exact perfect moment to jump into the market at its absolute lowest point, or cash out at the absolute peak for maximum profit. It's just human nature to want to optimize every single dollar. But let's dispel the myth right out of the gate. The honest, unfiltered answer is that you simply cannot perfectly time the market. Nobody has a crystal ball. But, and this is a massive but, while you can't be perfect, you absolutely can use data, understand market cycles, and read government signals to make significantly better decisions than the average buyer. You really can learn to read the market like a professional. So, here's our roadmap for this explainer. We'll quickly move from debunking the timing myth into understanding property cycles, the 5 key indicators you need, our specific buy signal framework, exactly when to pull the trigger to sell, and finally, the essential data sources you need to track it all. All right, let's kick things off with Singapore's property cycles and really understand these macro market trends. If we zoom out and look at the big picture, the property market reliably moves in these 7 to 12-year cycles, and it always reacts to major events. Look at the history. We saw a staggering 40% drop during the 97 and 98 Asian financial crisis, and a 25% drop during the 2008 global financial crisis. Then we had intense government cooling measures from 2011 to 2013, a totally surprising market surge during the 2020 pandemic, which then led to that massive 60% foreign ABSD measure in 2022. And looking ahead to 2025 and 2026, we're projecting a moderate growth phase, expecting about 3 to 6% growth for HDBs, with the private market staying pretty stable. Now, here is the absolute most crucial point. In over 35 years of data, Singapore's property market has never, not once, crashed back to pre-boom levels during any of those downturns we just talked about. The government has always stepped in with surgical precision to stabilize things. That safety net is exactly what makes Singapore property one of the safest long-term wealth stores in all of Asia. So sure, you'll see dips, but there has never been a prolonged collapse. Okay, moving on to the specific diagnostic tools. Let's look at the 5 indicators you must monitor. Because let's face it, you can't just operate on a gut feeling. These are the 5 exact indicators you have to watch to actively time your entries and exits. Think of this as your professional dashboard. We're going to break down the RPI for public housing, the PPI for private housing, SORA for your loans, the new launch supply pipeline, and those crucial government cooling measures. First up is your primary thermometer for public housing, the Resale Price Index, or RPI. This is published quarterly by the HDB. If you see this index rising for 2 or more consecutive quarters, ding, 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 that signals a hot market. That's your optimal window to sell your flat. If it's falling, you hold tight. And similarly, we've got the PPI, the Property Price Index, published by the URA. This one tracks the private market. It works in the exact same principle. A rising PPI over a sustained period means demand for private condos is running hot, making it a fantastic time to list your private property. Next, we have to talk about SORA, the Singapore Overnight Rate Average. This is the benchmark that dictates bank mortgage rates across the entire country. The logic here is incredibly straightforward. When SORA falls, mortgage rates fall. Cheaper loans suddenly flood the market. Buying affordability skyrockets, and property demand shoots up right along with it. Ideally, you want to buy when those loans are cheap and sell when market demand is artificially boosted by all that affordability. The final 2 indicators basically go hand in hand. Keep an eagle eye on the new launch supply pipeline. A ton of upcoming supply means future price pressure in about 3 to 4 years, so you definitely want to buy before that new supply floods the market. At the same time, watch out for government interventions. When new cooling measures drop, like higher stamp duties, prices typically stabilize or even dip for about 6 to 12 months. This creates a really golden, temporary window to buy while competition is low. Okay, so we have the tools. Now, let's talk about the buy signal framework and exactly when to enter the market. This is where we take emotion completely out of the equation. Your buy signal only triggers when all 3 of these specific conditions are met simultaneously. Number 1, interest rates must be stable or falling, ensuring your loans are cheap. Number 2, transaction volumes need to be relatively low, meaning less competition and much better negotiating power for you. And number 3, look for new MRT lines or major infrastructure completing within exactly 3 years of your target area. That infrastructure reliably boosts property values, practically guaranteeing future equity. When all three align, that's when you buy.
But hey, knowing when to buy is literally only half the battle. We also need to know when to sell and maximize your exit. To successfully build multi-generational wealth, you've got to know exactly when to recycle your capital. If we contrast our buy setup with our sell setup, we're looking for the exact opposite triggers to make a sale. You want to see the RPI or PPI rising for 3 consecutive quarters, you want high transaction volumes where properties are flying off the shelves above valuation, and crucially, you absolutely must be past your 3-year seller's stamp duty or SSD window to avoid getting hit with heavy tax penalties. Once you're past that 3-year mark and the indices are hot, boom, it is time to sell.
All right, wrapping up our toolkit, where do you actually find all this essential data? To track the indices, the supply, the volumes, you need the right sources. You're going to want to bookmark these platforms today. Hit the HDB website for public data and URA Realis for the official private transactions. For analytics and fair value, SRX and EdgeProp are fantastic. Use Property Guru and Orange Tea for trend spotting and quarterly research. And finally, check the MAS website to track Sora. Honestly, spending just 30 minutes a quarter on these sites immediately puts you ahead of 80% of buyers out there. Now, after all this talk about timing, I'm going to hit you with the most profound takeaway from all our source material. The ultimate meta principle is this: time in the market beats timing the market. Yes, timing your entry and exit using the indicators we just discussed might boost your returns by 10 to 20% over a full cycle. But simply staying in the market, holding appreciating assets over 15 to 20 years, is what actually builds generational wealth. The trick is to always be in the market, but just make your major moves during those favorable windows we outlined. You now have the exact frameworks, the cycle history, the 5 indicators, and the data tools to take total, absolute control of your property journey. The mystery is totally gone. It's just you and the data now. So, what's your next move going to be?